Cryptocurrency, particularly Bitcoin, has sparked intense debate in the financial world, with some investors calling it a revolutionary store of value and others dismissing it as a speculative bubble. For example, Warren Buffett famously referred to Bitcoin as rat poison, an analogy some enthusiasts have turned on its head, claiming the traditional financial system is the rat Bitcoin aims to eliminate. Over the years, Bitcoin has proven to be a polarizing yet transformative asset, prompting many to examine its unique characteristics and how to navigate the cryptocurrency market effectively. The rise of Bitcoin and cryptocurrency. Bitcoin's introduction in 2009 marked the beginning of a financial revolution. Designed as a decentralized digital currency with a fixed supply of 21 million coins, Bitcoin was created to address flaws in the traditional financial system, particularly after the 2008 financial crisis. Over the past 2 decades, Bitcoin has emerged as one of the best-performing asset classes, with returns surpassing 18,000% since 2015. Its limited supply and increasing adoption have fueled speculation that it could act as a digital gold, preserving wealth in a world of fiat currency inflation. However, the journey hasn't been smooth. Bitcoin and other cryptocurrencies often experience extreme volatility, with price drops of 50–90% during bear markets. For investors, this presents a dilemma. While the potential for high returns is evident, the risks are equally significant. Cryptocurrency as an investment. Investing in cryptocurrency can be lucrative but is fraught with challenges. The cryptocurrency market now includes over 15,000 digital assets, and of the 40,000 coins ever traded, only 38% have survived beyond a few years. This survival rate mirrors the stock market, where research shows that most individual stocks also fail to deliver long-term gains. According to an Arizona State University study, only 4% of stocks outperformed inflation-adjusted treasury bills over their lifetime. Similarly, in the cryptocurrency market, a small number of winners, particularly Bitcoin, dominate the overall returns. Bitcoin contributes 60% to the total cryptocurrency market capitalization, while the top 10 coins account for 89% of the market's value. This concentration highlights a critical similarity between cryptocurrency and traditional equities. A diversified portfolio, focused on quality assets, tends to perform better over time than speculative bets on unproven investments. Lump sum investing vs. dollar cost averaging. When investing in volatile assets like Bitcoin, timing the market becomes crucial. Historically, lump sum investing has outperformed dollar cost averaging DCA in 66% of cases for Bitcoin, according to data from 2013 onward. For example, investing a lump sum at the start of a bull market, such as in 2017, could lead to gains exceeding 700%. However, during bear markets, like in 2018 and 2022, DCA mitigates losses by spreading out investments over time. While DCA is less risky, lump sum investing remains statistically advantageous for long-term investors with a holding period of more than 12 months. This strategy aligns with the fundamental principle of investing. Time in the market often matters more than timing the market. The appeal of altcoins. While Bitcoin dominates the market, altcoins have also gained traction. Some lesser-known cryptocurrencies, like Dogecoin and other meme coins, have delivered staggering short-term gains. However, these opportunities often rely on luck rather than strategy, as most altcoins lack the adoption and infrastructure to ensure long-term success. A notable experiment in this space involves investing in the top 10 cryptocurrencies annually. Over the past 5 years, this strategy has delivered modest but positive returns, outperforming the S500 during the same period. However, this approach still carries significant volatility and risk, with occasional years of underperformance. Risks and emotional pitfalls in cryptocurrency investing. Investing in cryptocurrency is inherently risky, and many investors fall victim to emotional decision-making. Studies reveal that overconfidence is a significant detractor from portfolio performance. When investors succeed, they often attribute it to skill rather than luck, leading to riskier bets that may result in losses. Emotional responses like fear, greed, and regret also influence decision-making, often causing investors to hold on to losing positions or miss out on gains. Additionally, smaller investors may take outsized risks in pursuit of life-changing wealth, often chasing unrealistic returns that lead to significant losses. This dynamic is exacerbated by the rapid rise and fall of cryptocurrency prices, which can create a gambling-like mentality among inexperienced traders. The case for long-term holding despite the risks. Long-term holders of Bitcoin have historically fared better than active traders. The buy and hold strategy is often less exciting but more effective, as it avoids the pitfalls of market timing and emotional decision-making. Investors who allocate a small, manageable portion of their portfolio to Bitcoin, an amount they are willing to lose, tend to achieve better long-term outcomes. A Bloomberg study supports this approach, showing that adding just 1% Bitcoin to a traditional portfolio can increase returns by 1.3% without significantly raising volatility. This reinforces the idea that Bitcoin can serve as a complementary asset rather than a replacement for traditional investments. Regulatory and market trends. One of the key drivers of Bitcoin's recent resurgence is growing optimism about regulatory clarity. In the United States, proposals to incorporate Bitcoin into national reserves have sparked bullish sentiment. For example, Senator Cynthia Lummis has introduced legislation that would establish Bitcoin as a reserve asset, potentially positioning the U.S. as a leader in cryptocurrency adoption. Such initiatives align with broader trends, as countries like El Salvador and companies like Tesla have already incorporated Bitcoin into their reserves. If adopted on a larger scale, this could cement Bitcoin's status as a global store of value and further integrate it into the financial system. The greatest wealth transfer. Some enthusiasts argue that cryptocurrency represents one of the greatest wealth transfers in history, as early adopters reap massive gains. However, this narrative often overlooks the risks and volatility inherent in the market. While there is potential for significant returns, investors must remain cautious and avoid overexposing themselves to this speculative asset class. Final thoughts. Cryptocurrency, particularly Bitcoin, offers a unique opportunity for investors willing to navigate its volatility and risks. By focusing on long-term strategies, diversifying across quality assets, and maintaining realistic expectations, investors can maximize their chances of success. As the market continues to evolve, regulatory clarity and broader adoption may further solidify Bitcoin's role in the global financial system. Ultimately, the key to successful cryptocurrency investing lies in patience, discipline, and a willingness to only invest what one can afford to lose. By adhering to these principles, investors can participate in this exciting market while minimizing potential downsides.